I'd like to go ahead and turn the call over to our Vice President of Servicer Relationship Performance Management, Don Griffin. Don?
Thanks, Baha. Welcome, everybody, to the Servicer Information Session. We've had some excellent sessions over the past couple months, and we hope to continue that today. So I'm going to turn it over to Ben Gottheim, the Senior Director of Servicing Policy, to review some recent bulletin updates. Ben?
All right, thanks, Don. All right, so if you go to the next slide, we, as you guys probably are aware at this point, we had 2 new bulletins come out yesterday, and I'll talk to both of them. The second one probably just a little quickly to go over. So the first one on your screen, Bulletin 2020-25. It was all of 2-page bulletin, so it wasn't that big, but it did have some important topics. Number 1, specifically to COVID-19, is that as we had announced the prior week, we did formalize in a bulletin, as Fannie did in their lender letter, that the foreclosure moratorium has been extended through August 31st, 2020. Just for everyone's awareness as well, the eviction moratorium has been extended also to August 31st. In our bulletin, we just talk about foreclosure because our own REO Home Steps team manages our eviction process. So all foreclosure activity is continuing to be suspended through August 31st, 2020. And, after that point, we'll just have to wait and see what happens. That's the approach that the FHFA has taken, along with other government agencies, as we continue to see the impacts of COVID-19. Then we had 2 other topics in this bulletin, both related to EDR, or electronic default reporting. One, I'll actually go to the second one first because it's a little easier. It was related to EDR when you send a streamlined offer for a flex modification. When we have a code, it's code HD, H is in Harold, D is in David, that you're supposed to report to us anytime that a modification offer is out there. Once it's actually performed on a trial plan, there's a separate code for that, the BF code. But you're supposed to report code HD to us anytime the mod offer is outstanding to the borrower. And what we wanted to clarify with this, because we've got a lot of questions, some confusion, is, in the event that that the offer is made mid-month and it's still, good the following month, should the servicer, should you guys report it again, 2 months in a row? And the answer is yes. You should continue to report that code for the months that the offer is still active and valid for the, where it hasn't been denied yet by the borrower or the offer hasn't otherwise expired. That information is really important to us in terms of the loans that are in our PCs or our UMBS securities. Also, it's just accurate reporting. So we wanted to clarify that. The second thing is a kind of bigger topic, and that is reporting EDR for loans in forbearance, specifically loans that are current. This applies beyond COVID, just like the other topic. It applies beyond COVID, although this is somewhat in response to COVID-19. And so in our guide, we say you must report all delinquent loans to us through EDR every single month. Additionally, in some instances, you must report current loans to us. Those are going to be your cases of things like bankruptcy. And we've also always said, or an alternative to foreclosure, although it's always been unclear whether forbearance falls into that bucket. And also, we've never required a reason for default to be reported on a loan that is current. So therefore, we are not aware of loans that are in our portfolio that are current, but also on a COVID-19 related forbearance. And we know that there, from feedback on these calls and other mediums, we know that there are a lot of borrowers out there that are current, yet on forbearance. And that's information that we want to see as well. So we have we put out in the bulletin effective no later than October 1st, meaning your September EDR cycle that you'll report in the first couple days of October. Then you must report all forbearance loans to us, including those that are current, and you must report the reason for default code. So if it's for COVID-19, it would be the National Emergency Declaration Code 032. If it was disaster, 034, whatever the reason for default is, this is not a COVID-specific policy. So always report a forbearance to us, even if the loan is current. Always report the RFD code to us, a reason for default. And the other piece that we put in here that was explicit, so that we can tie our data together and make sure that what's being reported to us is what's being matched in your system. Is that the date that's on? We're asking you to report the date that the forbearance would start, meaning the date that you're going to have on that agreement that you have to send out to the borrower. So I think we give an example in the bulletin that says if the borrower calls in today, for instance, and says, I'm going to need forbearance. I am current, but I'm going to need forbearance, and that forbearance is going to start with the July 1st payment. You're going to report the code. You're going to go to EDR. You're going to report 09 to us. You're going to report 032 as the reason for default code, and you're going to report the action start date as July 1st, 2020. And that way it'll, again, match what your letter is, because you're telling them in your agreement you're approved for forbearance from X date to Y date. Those dates should match. And then you can report the date to us every month, unless it changes because maybe the agreement has been extended or whatever the case may be. And that way we'll have uniform data. Everyone's reporting the same way. So this will be really good for now and go forward, so that there's removing any inconsistency and any lack of clarity that a lot of you brought to our attention over the last few months in this space. So we're glad to get that out there. So that was the bulletin 2020-25. Baha, if we can move on to the next slide, I'll talk about the other bulletin that we released yesterday really quickly. Perfect. So bulletin 2020-24. It's earlier number because it went out technically 20 minutes earlier. That's our own sausage making. Under this bulletin, this is another one that was aligned with Fannie Mae, working with our regulator and conservator, FHFA. It's about liquidity requirements related to mortgages with COVID-19 related forbearances. So a number of you, specifically if you're an independent bank or non-bank, you have to follow our liquidity requirements in terms of eligibility to be able to do business and sell and service loans to Freddie Mac and also to Fannie Mae. Has a number of different financial measurements and triggers, and there was a concern in the industry that with the rising number of forbearances that a couple of the triggers may be hit and have some unintended consequences. So what this bulletin really does is just temporarily, I don't want to say relieve that marker, because it's not really a relief. It's just temporarily changing it so that it's more accurately reflecting liquidity requirements in this current quick hitting pandemic. So that's all this bulletin really talks about. I would advise, if any of you on the phone after reading this bulletin, have questions about it or need to talk through it because you are subject to this, reach out directly to your account manager or to 1-800-FREDDIE with those questions. So those were the two bulletins. Again, really quick, and I think, if I'm not mistaken, Baha, we're going to turn it over and open it up for Q&A at this point. Is that correct?
Okay. Thanks. Yep. Thanks, Ben. So at this time, we'll go ahead and open it up for Q&A. If you do have any questions, go ahead and select the raise hand icon located on the right side of your screen, or feel free to type in your questions via chat. We'll take questions now. All right. First question comes from Mark. Mark, your line is open.
Yes, I had two questions real quick, if I could. Ben, going back to the EDR and current mortgages that are under COVID-19 related, are these people allowed in any way to make any kind of principal reduction payment on their loans?
If they're current on their mortgages, but also in forbearance, yes. If a borrower, and I will ask John Felix to ensure that we have no system issues, but if a borrower is current, regardless of anything else, they always have the ability to make a curtailment.
Okay. That is correct.
Yes. So I just wanted to clarify that because our servicing department wasn't sure. And the other quick question I had regarding the extension of the foreclosure moratorium, how is this going to affect foreclosure timelines state to state? Will we be penalized in any way?
How is it going to impact? So obviously we have not updated our foreclosure timelines in a couple of years, right. And that was actually done somewhat intentionally. And actually all the timelines had come, frankly, well down, and we hadn't touched them in a couple of years. The plan originally, again, we do a lot of the stuff in alignment through FHFA, and the plan was always to update them at the end of this year using the most recent data. I don't have a clear answer for you as to what will happen in that space, whether we'll update them based on the very limited amount of information we have, or if it'll just be deferred. Ultimately, I think that there's a lot of realities in this situation,
Right.
and there can't be measured performance against things that couldn't happen because we placed a moratorium. You will not be penalized for a moratorium that we have made you put in place. To the extent of what timelines will look like, or how any of that stuff will be codified into policy, is something that we'll address, frankly, after the moratorium ends, which again right now is scheduled for August 31st.
Okay, thank you.
Great. Next question that we have comes from Kayla. Your line is open.
Actually, I sent my question in through the chat, but it was basically when reporting the forbearance, should it include the TNI or just principal and interest?
So reporting a forbearance to us is all you're doing is reporting the action that the borrower is in forbearance. So you're reporting three pieces of information to us. You're reporting, that they are in forbearance, so code 09. Your report, which is, I think, the status code. You're reporting to us the reason for default code, and you're reporting to us the start date of the action. That's all you're reporting to us, and you're not reporting, any payment or principal balance movement in the EDR system.
So if they try to pay back or set up the flex modification, I guess that's that forbearance include that we're going to forbear, or should it only include the principal and interest?
I'm really sorry. I'm not going to be
able
to
caught up. Standpoint.
Yeah, and I'm happy to answer it. I think your question I think you cut out. At least I cut out on my end. I don't know if you can repeat your question.
From a loss standpoint,
mm-hmm.
When creating the forbearance or putting the information into Prospector, should the forbeared amount include just principal and interest, or should it include the full mortgage payment if they have their account escrowed through us?
Okay. And so on that one, we do have Sergio Bustos, and I don't know if Sergio or John's the right one here. I didn't think we entered forbearance into Workout Prospector, but Sergio, is that something you're able to help out with on an answer?
Yeah. No. You wouldn't be entering the forbearance through Workout Prospector.
Yeah. So you don't have to model forbearance for us.
Correct. That's something that would be delegated on your side, and if any exceptions requests need to come in, then it would be a multi-purpose form that would be sent over to us, but no forbearances would be entered through Workout Prospector.
Okay. So it's treated. So are you saying basically it's treated completely separate? We don't have to create a modification for each one of these loans?
No. So a modification is something that may take place after the fact, right? After the forbearance is over, you're going to have to get you're going to work with the borrower to figure out what happens and how you're going to, hopefully bring them back current, or, potentially go down the liquidation path. And modification obviously is in the waterfall, right? Reinstatement, repayment plan, payment deferral, loan modification. If you get to one of those payment deferrals or loan modifications, those do have to be entered into WP, but you wouldn't do that until after the forbearance is over and you've worked with the borrower to figure out what the right solution for them is.
Okay. And also, do you have any bulletins that would kind of go over repayment more?
Sure. So, well, I don't know if you guys know this, but yeah, those numbers in the bulletins, those are numbers of how many bulletins we put out this year. So it's been a lot. I will say Bulletin 2020-15 is the one we put out. That was the COVID-19 payment deferral. That's the program we've been talking about on this call for a number of weeks. That gets borrowers back on their feet, assuming they don't need payment relief. And then there is the Flex Mod. If you need more information on how to enter the stuff into Workout Prospector, we do have a Workout Prospector user's guide, and I believe there are a number of trainings that have been set up already. And I think I'll ask Sujatha to elaborate on the trainings in a second. In terms of underwriting the borrower and using the hierarchy, into the mods, there are a number of guide sections. So you want to go right into the guide that'll include all of this, and that's generally going to be found. There's a hierarchy section. I'm sorry that I don't know it off the top of my head, but it's in it's in, I think, 9200, series 9201. So you can go through that. That has the hierarchy. Then it goes into the modifications, and all of it's laid out within our guide in an order of how the hierarchy works.
Okay. So at the end of this presentation, there's actually a list of the trainings that are available in the next couple of weeks. They are getting full, so I would definitely recommend you guys get on trying to register for them quickly. Maybe, Ben, we take a couple minutes and have Don just go through the PD example one more time.
Sure.
Baha, can we scroll down a couple of slides to the example? What is it?
So this is a calculation Freddie did as an example for you to see how to calculate the payment deferral terms. And on the left side, we just quote the current status of the mortgage, $200,000 balance, 4.875 interest rate, DDLPI March 1st of this year. Total payment, $1,258.42, including your P&I breakout, your T&I breakout, $100 in accrued late fees, and a negative escrow balance, and a servicer advance balance of $800 as well. And then in the middle of the page, titled Payment Deferral Amortization Calculation. And what this really depicts for you is during the forbearance period, assuming a 6-month forbearance period, it shows you how the loan would have amortized had payments been made. And that's very significant for the payment deferral calculation. A total of $1,490 in principal, a total of $4,859 in interest, and it also shows what they normally would have paid in taxes and insurance into escrow, $1,200 over that 6-month period, and it shows the UPB being amortized from $200,000 down to $198,509.41. And then below that box, in the middle lower section of the page, it's titled the COVID-19 Payment Deferral Non-Interest-Bearing UPB. This is the calculation you need. And you take the $1,490 in forborne principal from above, the $4,859 in interest from above. Now, this is where it gets a little tricky. The negative escrow balance, you're able to move that to the non-interest-bearing balance. So $400. I'll talk about that in a minute. And the servicer advances of $800. All four of those total $7,550 will be placed in a non-interest-bearing UPB. The interest-bearing UPB is now $198,509, and you can follow me on the right section. These are the loan details after the payment deferral has been accepted. So I got your adjusted interest-bearing, your non-interest-bearing UPB. The interest rate remains the same. It was a 6-month forbearance period. You put those appropriate amounts into the non-interest-bearing bucket, and you now advance the due date, DDLPI, from March 1st to September 1st, 6 months. The next payment is October 1st, the next due date. Their total payment is $1,258.42. This is the same as the pre-payment deferral payment. Okay?
Mm-hmm.
Now, the one thing we did not do in this example is an escrow analysis. Keep in mind they should have paid $1,200 in escrow payments to you, the servicer. You would have put them in the escrow bucket to make disbursements when they're due. That is not a shortage. They were simply not paid. It's very likely the longer the term of the forbearance and the more escrow that was not paid, that there will be a shortage. But in order to actually have an escrow shortage, you must do an escrow analysis. It's up to the servicer to determine when to do that escrow analysis. Typically, you have an annual escrow cycle, and many servicers prefer to do that during that annual escrow cycle, and other servicers prefer to do it at the time they're evaluating a borrower for a modification. So when you're doing this payment deferral calculation, if you do an escrow analysis and you do indeed have an escrow shortage, you can spread that shortage over a period of time from 12 months to 60 months. Okay, and that would change the total payment due. But we did not do it in this example. We may come up with another example, next time we meet or thereafter to review a situation like that. Late charges accrued is 0. And the reason is, under this program, you have to waive all accrued late fees. No late fees accrued during the forbearance period, but all previously accrued late fees must be waived. Your servicer escrow advance is now 0 because you put that $400 negative balance into the non-interest bearing, and the servicer advances have been reset to 0 because once again, you put the $800 in advances into the non-interest bearing balance. Those are the terms of the new payment deferral going forward. I hope that's helpful. You may have some questions. We had a lot of questions last week, so we're certainly open to questions.
Great. Thanks, Don. All right. Next question comes from Joe. Joe, your line is open.
Yes, we've been having issues with the loans in forbearance and reporting them to the credit bureau because we were informed, like using the special code AW to report a natural disaster or CDP account in forbearance, it wouldn't show us past due, but they are. It's affecting their score. But we're still supposed to leave them past due on our system, right? Because they haven't made the payment?
Yeah, so when reporting to Freddie Mac, it's going to show up as a delinquent loan on forbearance in terms of what you're supposed to report to the credit bureaus. Under the CARES Act, you need to, if the borrower was current prior to all of this, you need to keep reporting them as current. In terms of the other codes like the AW, unfortunately, I think we have to direct you to CIA's guidance or the bureaus themselves, what guidance they have for reporting. It's we don't have any policy or requirement of you in that space other than to follow the law.
Okay. So basically, we have a lot of manual changes to make. And I had a question on, now the deferral, COVID deferral thing is supposed to be available July 1st, right?
Yes.
Okay. And I did have a question on the escrow shortage when you do the analysis, for like the 1,200 he was talking about, and how you can stretch it over 12 to 60 months. Has that ever been discussed with some of the core banking systems that they would actually be able to do that? Because a lot of them, my experience is most of them only allow you to do 12 months, and you have to manually make those calculations when it goes to 60 months.
So I'll speak to a couple things, and if anybody else wants to jump in. One, you asked, is the COVID payment deferral July 1st? Yes, it is. That is just, let me put the plug in and remind everybody, July 1st is the date that the evaluations must begin. So anybody coming off of forbearance at the end of June that was current, or one payment down at the start of the national emergency is now eligible for the payment deferral and not for extend mod or cap and extend mod. The second point I'll make on that is that our system, Workout Prospector, that you'll have to go and input and then settle through, will be available to take in the COVID-19 payment deferral on Monday, July 13th. So if you are working with a borrower to get them set up on that payment deferral in those first 12 days of the month, you may absolutely do it. But then you submit it to us in settlement, on July 13th or after to get that loan completed. as it relates to the escrow piece in 12 to 60. So we've gotten actually a lot of questions, and thank you for reminding me. I meant to bring this up earlier. We had actually initially had this topic in our bulletin for yesterday. We pulled it out again. We do a lot of this stuff in alignment with Fannie Mae. If you read our bulletins and you add it all together, you'll know that on loan modifications, we allow for escrow shortages to be spread out anywhere between 12 and 60 months. An amount that you're going to determine working with the borrower, but within that time frame. It wasn't exactly clear that on payment deferrals that we were adopting the same policy. Again, you kind of get there if you read between the lines. But we do plan in our next bulletin to explicitly state, as a clarification, that on payment deferrals, escrow shortages should be split between 12 and 60 months as well. In terms of the systems and being able to handle that, I don't know if John or anybody has anything to say. The systems that I've worked with have been able to handle that. We've had that kind of policy out there since the last crisis with the loan modification. So I think a lot of the typical service bureau systems can work with that. But I don't know, John, if you have anything to add there.
No, I would kind of, same thing that you had said, that most can do it, and if they can, you probably need to have that conversation with that particular service provider. We have, as you can imagine, there's lots of servicers that are on lots of different platforms. As we make our announcements, we don't specifically go to every service bureau or banking system to make sure that they can handle any of the changes that we're making.
Great, thank you.
So if you're working with one that you need us, you need our help with, Baja, I think we can contact directly, and then you can let us know if we need to help you out with any conversations.
Okay, thank you. Appreciate it.
Great. All right, next question that we have, I think, goes to the example that we went over with the payment deferral. Is the escrow advance the negative escrow balance at any point during the deferral period? What does the servicer advance consist of?
Didn't quite catch the question about the negative servicer escrow advance.
Sure. Let me go ahead and repeat the question. Is the escrow advance the negative escrow balance at any point during the deferral period? What does the servicer advances consist of? So,
two questions, obviously. Let's take the negative servicer escrow balance first, the $400. The example we have above does not show escrow disbursements. They could have occurred during the forbearance period, or they might have occurred prior to the forbearance period. But obviously, the servicer had to advance its own funds on behalf of the borrower for the payment of taxes or insurance in this case. So I hope that answers that piece. The servicer advance of $800 could be a variety of different charges. Could be property preservation expenses, inspection, drive-by inspections. It could be default advances. Could be anything that had accrued to that loan and been advanced by the servicer over time. The detail is not shown here. It was just a theoretical example. But they would be legally recoverable from the borrower. If there are any advances that are not legally recoverable from the borrower, and there are certain states that have certain rules, and Ben Gazheim would love to talk about it, you could not include those as part of the non-interest bearing UPB.
Correct.
Great. Thank you, Don. Next question that we have comes from Paul. Paul, your line is open.
Oh, how are you guys doing? Good afternoon. Just a quick EDR question, if you didn't mind, since you spoke a little bit about it earlier. So just an example, I have a loan in the forbearance, and the borrower's in the forbearance, just for an example purposes, May, June, and July. He contacts the bank during the month of July and says that he is stable and can begin moving payments starting in August. We process through Workout Prospector the month of July. Just curious, how would you recommend reporting in EDR for the month of August?
So what's happening in the month of, it depends what's happening in the month of August. So you said that the forbearance in this case is going to end on July 31st, right? It's going to end at the end of July. So, when you report in the first 3 business days of August, that's July's activity, you're going to report the 09 code. And that'll be the last time you report that. And what you report in EDR in the month of August, which would be made in the first few days of September, is going to be whatever's happened next. So if if you have the borrower on a repayment plan, I think it's code 12, you'd report with the start date. If it's a mod trial plan, you'd report code BF with that. If the borrower is making a payment, but you have nothing else being worked out with them, hopefully that's not the case, then I think you're just reporting. Actually, that's a great question. I'll ask John to weigh in on that. It used to be that you'd report the increased DDLPI. But if it's a payment deferral and the loan has now become current, in August you completed the payment deferral, it's now a current loan, I don't think you report anything in EDR. But John, I think I questioned myself enough that I need you to step in and answer that a little bit better.
You were right on, Ben. And then, if that borrower became current, then there wouldn't be anything to report to us in that month.
So,
and what about the situation where a borrower makes a payment?
So typically when a loan, if we have a modified loan, when they become current and they're no longer in it, we have to report, or if they're in foreclosure, we have to report a reinstatement 20. We don't have to do that with these deferrals?
No.
Oh, perfect.
Awesome. Thank you.
Great. All right. Next question. With the update to the current forbearance reporting, will you be removing the error 513?
John Felix, I'm not even gonna take a swag at that one. That's all you.
Good call, Ben.
John, you're on mute.
Sorry about that. I was on mute. Thanks, Ben. So you were asking if we're removing the 513 EDR error code?
Correct.
Because that code is for action date cannot be after today's date. I'm going to have to, because I'm thinking all default action code dates, have to be historical or current and cannot be a future date. So I'm not sure if I really understand that. In what aspect would they think that they would be reporting a future date?
No worries. What I'll try to do is I'll try to get that attendee to the client to go ahead and explain a little further in detail. Hopefully we can unmute their phone line.
John, actually, why don't I take a stab at
Sure.
elaborating on what I think that question means, because I think it's probably related to what I said as an example. I may have an example, borrower calls in today is June 25th. Their forbearance is going to start on July 1st. They're going to report, they would report when they do their EDR in the first 3 business days of July, they're going to report code 09 with a start date of 7/1. Are they going to get error code 513 in that instance?
That's a great question. We're I'm gonna have to take that back, Ben, and then we can reply back on that to this group.
Yep.
We'll take that back. So again, if you do have any questions, go ahead and click the raise hand icon on the right side of your screen, or feel free to type in your question via chat. All right, here's a question. How do we report loans that are coming out of COVID-19 forbearance that have been paid through the current loan, the loan current, that have been paid through the loan that's been current? Let me go ahead and try to reread that question. Give me 1 second.
Yeah.
How do we report the loans that are coming out of COVID forbearance that has been paid? And I believe it's if the loan is current. I might try to have to get that person to unmute their phone line as well to.
Yeah. So I think, a combination of John and I will try on this one as well. So in the event the borrower is on forbearance and they're not making a payment at the end of the forbearance, they reinstate in full. I believe, John, correct me if I'm wrong, they'd report code 20 in EDR, they'd report the activity in our loan level reporting, and that would be it. If the borrower is on forbearance and they're current at the end of the place, reporting the
Oh, Ben, just give me 1 second. Let me actually, I think we're doing some background noise. Oh, there you go.
Okay, do I need to repeat
Benny,
that? I'm sorry.
If you can, please.
Yeah, sure. So in the event at the end of a forbearance, a borrower is delinquent, but they then reinstate at the end of the forbearance, I believe in EDR, you'd report code 20 or the reinstatement code to us, and you'd report the payment activity in loan level reporting, including the advanced DDLPI, and that would be the last time you'd report EDR on that loan unless there was a subsequent delinquency or forbearance. If the loan is current at the end of the forbearance because they were never delinquent, they were just on forbearance for 3 months and made all 3 payments, all you would do is just stop reporting the forbearance code to us in EDR. That's all you'd have to do.
Great. Next question that we have comes from Mark. Mark, your line is open.
Yes, on the deferral example that you gave with the non-interest-bearing UPB of 75, 50, 52, how are we to put that dollar amount? Is Jack Henry capable of us putting that to the back of the loan, or are they still working on that?
This is John. So we haven't had any conversations with them. I don't know if they've provided you any feedback of what they'll be doing, but remember, we do currently today. We have a field that would be the non-interest-bearing UPB, and it's not just used for the COVID-19. So I would assume that Jack Henry, on any prior loans where there's any deferment, they have that field available in their system in the event that you have to report it to us. Again, as we had said a little bit earlier, if you want to kind of circle back with your contact there at Jack Henry, and if you're still, you're not getting that warm and fuzzy of what they're going to be doing, then please, reach back out to us. We have some contacts there that we've used in the past, and we can help, move that conversation along.
Would that be similar to a loan modification when we have to, in that scenario, put that money to the back of a loan, so to speak?
If it was going to a non-interest-bearing UPB.
Correct. Right.
Yes.
Okay, gotcha. All right. Understand.
Right. So in our systems, it'll be the exact same as the loan modification when you settle and work out prospector, exactly that way in terms of Jack Henry's system. As John said, if we're not exactly sure what updates they're making or any changes. So if you need us to be part of that conversation, let us know.
All right. Thank you.
Great. Next question comes in via chat. That question is, if a borrower is greater than 31 days delinquent on March 1st, enters forbearance plan for COVID-19 much later, let's say June, and is less than 30 days delinquent at that point, would they qualify for the COVID-19 deferrals?
Okay. I have to admit, I don't know if I followed all the dates in there. First, let's start at the beginning. So in this example, kind of the clarifying thing, and let me first just state that we are aware of the historical way in which we've talked about delinquency in terms of loss mitigation eligibility. Overall needs to be simplified. It's not something that you do in the middle of a pandemic. We will work on that as soon as we can. The simplest way I'll say to everyone on this call is, and we have an FAQ on this, if the DDLPI was January 1st, 2020 or later at the start of this national emergency declaration, they are eligible for the COVID-19 payment deferral. They don't have to be on a forbearance beforehand. They also don't have to be on a forbearance the entire time beforehand to continue to be eligible in that instance. The only other eligibility criteria is when they are doing the payment deferral, there's no more than 12 months of delinquency being included in that non-interest bearing balance. So again, DDLPI on or after January 1st, 2010, eligible. Less than 12 months of delinquency included in the non-interest bearing balance, eligible. Whether they were on forbearance or not is not a prerequisite or necessary. So I hope I answered that question.
Great. Thanks for breaking that down for us. And if you do have any questions, go ahead and select the raise hand icon, and we will unmute your phone line. Looks like we have a question from Connie. Connie, your line is open.
Hi, thank you. Just to kind of clarify two things. So just to clarify what was just advised and of the absolute latest DDLPI, I think from my last understanding on this webinar, it was February 1st, 30 or 31 days prior to the national declaration, which is March 1st. So now that date is January 1st, 2020. So an account can be due for January 1st, 2020 and qualify for a COVID forbearance or COVID deferral.
Yeah. So remember, when I say DDL 11, that's the DDLPI. That's right. That's the pay date, not the due date. Yeah. But all you've done is prove the point that we need to be clear. We do. We know we do.
Okay, perfect. All right. Thank you so much. Yeah. Okay.
Yeah. There's no reason for you to be confused by that.
Okay. Thank you so much. Understood. Now, my second question actually was, so I've been getting a few inquiries from borrowers who are kind of, staying alert on the news outlet lately, and they were concerned that another, scenario where they won't be able to afford due to another stricter shelter in place, coming about later on in the year, possibly with the health officials announcing, possibilities of, this not settling anytime soon and only getting worse. So they've asked if COVID forbearance is only a one-time deal, say whether or not they entered into one, we're able to defer it or we're able to reinstate it and we're able to modify it, whatever post-COVID option that they took after they first entered it into the initial COVID forbearance, are they able to enter into a COVID forbearance again later in the year?
So there is a really long answer to that one, and I will try to avoid that. And hopefully this will answer it still shorter, even with that preamble. COVID forbearance is realistically kind of the one-time deal. However, forbearance is not a one-time deal. Exactly. Right? We always allow forbearance. And remember, everyone, the difference between the COVID-19 forbearance and a forbearance for any other reason is that generally forbearance can be approved for a borrower with any temporary hardship for up to a year of delinquency. The difference with COVID is that can expand beyond 12 months. So if they come off forbearance because
with the credit reporting.
There is, and so that is part of that as well. Although again, we aren't dictating what to report with credit bureaus and any of that stuff as well. But I would say this: if your borrower, their hardship has been resolved and they can afford to start repaying again, they should. If they're concerned about what's going to happen in the future, I think we all share that concern. I think we share that concern before there's ever a pandemic as well. It's something that we can't control. The one thing that I can tell you guys as servicers is I think you saw what happened when this pandemic hit, and that we came out immediately with a bulletin of policies, and we updated them as quickly as we can when the CARES Act came out, et cetera. And we will continue to do that, and you can continue to do that with your borrowers. We will be responsive. We will react to changes as they come. We will do it very quickly. We have already, but we can't predict the future. So, the reality is we have to be in a reactionary position.
Got it. Okay. Understood. All right. Thank you.
Great, thanks, Connie. Next question that we have comes through chat. If a borrower wants to start forbearance, do we leave the next payment due date as is? So if the request is to start in June, when they come in, when July comes for their next payment due date, would it still show as the June through the entire forbearance period?
Yes. It would still show as June as the time the forbearance started.
Great. And if you do have any questions, go ahead and select the raise hand icon located on the right side of your screen. We will unmute your phone line. All right, here's another question. Does loan accounting need to report the payment deferral terms the same way that the payment deferment settlement, or can they report the payment deferral terms 1 or 2 days after the settlement?
I'm going to attempt to paraphrase that question, and if it's not correct, please call in or raise your hand and re-ask it so we can get it right. But I think what the question is, do I need to do my loan level reporting to report it as current at the exact same time as it's settled in Workout Prospector, or can I do it afterwards? I think is the question, and I think I know the answer, but I'd rather hear it from John and Sergio to make sure that it's correct. So, John, do they have to bring the account current at the exact same, time?
No, it does. It does have to. Yeah, it doesn't have to be done at the same exact time. What we would suggest is, settle that in, do it through Workout Prospector, and then after you can report through loan level.
Thanks.
Great. Next question. Does the borrower need to be qualified for the repayment plan?
So, they need to be approved for whatever loss mitigation that solution that you're offering them in terms of qualified. If that question is, do I need documentation or do they need to provide any financials? The answer is generally going to be no. There are some situations, if it's a longer term delinquency, that CFPB's RESPA will require you to obtain, what we'd call a borrower response package. It's a very unlikely scenario to begin with. But in those situations, you may have to, but you don't need to qualify that before you've, agreed to what the right solution is for the borrower. So if you're walking through the waterfall with the borrower and they say, I can't afford a reinstatement, but I can and want a repayment plan, and they do require documentation under RESPA, it's only at that point that you'd have to get the documentation from them. You wouldn't need to get it as a disqualifier or to confirm that they can afford it before they've stated verbally whether they can afford it. You'd only need to, close that gap after the fact. So generally, you will not need to do any qualification. In some small instances, you may under Regulation X or RESPA.
Okay. Next question comes from Tina. Tina, your line is open.
Hi, can you hear me?
Yes.
Okay, my question is, I have a couple of borrowers that took the 6-month forbearance, but now after 3 months, they want to pay the month of July. And the first two options, reinstatement and repayment plan, doesn't work for them. So they want to go with the deferral program. I know we can't evaluate until July 1st. After everything's settled through Workout Prospector, are they able to make a payment in July?
Yes. And that in that instance, realistically, if you're going to settle it in July, it means the first payment due under the now payment deferral loan, it's the same loan, but we call it under the payment deferral, would be August 1st, the August 1st due date. So the payment that comes in July will probably be applied before you'd complete the payment deferral, and that's fine, right? In fact, it's a good thing for the borrower because what it means is they've made their payment, and they're, the balloon or the non-interest bearing balance is going to be, smaller, right? Less they're going to have to pay off at maturity. It means they're just paying it now. That's perfectly fine and acceptable, and it's frankly a good thing if they can afford to do that.
So it's, I'm sorry, so I wasn't accounting for the month of July, like including that in the numbers for the workout prospector, but I should.
Right. No, you don't. No, I think.
No.
Thank you. I was saying the opposite. So if I wasn't clear, let me clarify. No, do the opposite. In this instance, because the first payment due under the loan, once it has this balloon at the end, will be due for August 1st. Then you want to apply the payment, and then when you're putting it into workout prospector, you're only going to put in the payments that have been missed, which would not be that one payment. So if they had a 3-month forbearance and then made this payment, it'll only be inclusive of the 3 months of payments that are going to be deferred into that non-interest bearing balance.
Okay, thank you.
Great. Next question that we have comes from Nicholas. Nicholas, your line is open. Hey, Nicholas.
I'm sorry, I was on mute on my own phone. So with our other Freddie Mac reviews, we pulled the Freddie Mac exclusionary list. Will we continue pulling this list for deferments?
Yes. Right. So we, anytime that you would, as with all other loss mitigation, people on the exclusionary list are ineligible.
Okay. And one more question. So for WP, for the first 12 days of the month, we're not going to be able to upload anything WP for the deferrals. Is there going to be a bulk upload option kind of thing out there, or is it just one at a time for every single one?
I could take that one.
Thanks.
There's not going to be a bulk upload feature for those loans in WP. So what you see right now in WP on the kind of as a link on the side, that's not an active link. It will need to go in individually.
Okay, cool. Thank you.
You're welcome.
Great. Thanks, Nicholas. It looks like we are out of time, and I know, Sujatha, you wanted to make a quick announcement as well. But before you do that, I just want to remind folks that there is that brief survey question if they can take the time to respond. It's located on the right side of their screen, so we can continue to improve these calls. So, Sujatha?
Hey, Bob, can you scroll down two slides? Or one slide? Hi, everyone. So I wanted to give you just a quick logistics update. Again, we apologize. Last week's deck was not sent out. That is why we included the payment deferral example in this week's deck. We will definitely send it out tomorrow, so please do look out for that email. I wanted to make sure you were also aware we've updated the training information. Some of the classes are getting full. These are the ones that are currently available. So again, please make sure you take the opportunity to register for some of these trainings. Additionally, next week, we are not going to have this call. It's a holiday week for July 4th, so we want to make sure we will take a break, and we'll come back the following week again. One other thing, in addition to that, we've heard some feedback that you all are interested in having some of these recordings. We are working to capture all the recordings in one location so that we can post them there for you to hear as well. So I just want to give you an update that we're marshaling to get copies of all this information into one place for you all to be able to get to them.
Great. So with that, we'll turn it over to Don for closing remarks.
Thank you. So thank you, everybody. We appreciate your participation, your very thoughtful questions. It was very insightful. Thanks to the panelists for answering those questions. There's some pretty tough ones coming at us now, so that's good. And thanks for everything you do every day for Freddie Mac. Hopefully this will help you assist these borrowers on a timely basis. And if you do need help, please reach out. Remember, 1-800-FREDDIE is available to help you. The training programs that Sujatha referenced and showing up on the screen, all good information, and we will be back to you in July. And we look forward to helping you then. Thank you.